We're kicking off today's coverage with a notable shift in market leadership that's been building beneath the surface. While the broader tape is flashing red this morning, the S&P 500 declining and the Nasdaq 100 sliding, the Dow Jones tells a different story entirely. Yesterday, the Dow touched a record 51,702, powered not by megacap technology, but by a rotation into names that most investors had quietly been writing off. Healthcare stepped into the spotlight, and the options market is signaling that institutional money thinks this move has legs worth betting on. Here is the hard data that anchors this story. On Thursday, the Healthcare Select Sector ETF, ticker Healthcare, saw approximately 5,300 call contracts purchased against roughly 1,000 puts, producing a call-to-put ratio of 5.3 to 1. That is not retail noise. That kind of lopsided skew typically reflects coordinated institutional positioning ahead of an anticipated catalyst or a deliberate sector rotation. Simultaneously, the Dow Jones Industrial Average notched a fresh record close at 51,702, a milestone achieved almost entirely without technology's help. Meanwhile, the Nasdaq 100 declined 0.48% that same session, underscoring the divergence happening in real time across major indices. The deeper driver here is the intersection of two powerful forces: tech concentration fatigue and a rising rate environment that is quietly repricing yield-bearing equities. The 10-year Treasury yield sits at 4.53% today, up 123 basis points, and Treasury yields across the curve have climbed significantly. When risk-free rates push above 4.5%, investors begin demanding more from equity risk premiums, and suddenly the dividend yields embedded in healthcare giants start looking competitive against stretched technology multiples. Healthcare also carries a defensive character, revenues tied to aging demographics and recurring prescription demand, not discretionary consumer spending or enterprise software budgets vulnerable to a slowdown. The primary beneficiaries of this rotation are the heavyweight names inside healthcare. UnitedHealth carries the largest weighting and serves as the sector's bellwether. Its earnings trajectory sets the tone for managed care broadly. Johnson and Pfizer are the classic yield plays, attractive precisely because their dividend profiles look compelling relative to the 4.53% 10-year. ABBV brings a biopharmaceutical growth angle that adds upside optionality. On the other side of the ledger, the Nasdaq 100 faces continued headwinds as relative underperformance reinforces the rotation narrative. Utilities may also lose defensive safe haven flows to healthcare if this thesis gains traction, and volatility levels suggest that the rotation is not entirely orderly. The most critical variable to monitor is whether the 10-year Treasury yield sustains above 4.5%, currently at 4.53%. That level is the dividing line where healthcare dividend yields remain competitive, but further yield expansion could erode the relative attractiveness argument. Watch healthcare's technical support. Any breakdown below recent consolidation would invalidate the bullish call positioning and likely trigger forced unwinds from those 5,300 call holders. Volatility metrics are already nudging into warning territory, suggesting that if healthcare disappoints or macro data surprises to the downside, volatility could re-accelerate quickly and flush the rotation trade before it fully develops. The bottom line is straightforward: a 5.3 to 1 call-to-put ratio in healthcare is a statement of institutional conviction, not casual speculation, and it arrives at exactly the moment when tech-heavy indices like the Nasdaq 100 are underperforming while the Dow is printing records. But conviction alone does not make a trade work. Healthcare's leadership thesis lives or dies on whether sector earnings can justify valuations in an environment where the 10-year sits at 4.53% and volatility has shifted higher. Keep healthcare's relative strength and volatility stability on your radar as the two gatekeepers of this rotation. That is the full picture on healthcare's breakout bid today. Coming up, a story reshaping how global capital flows through one of the world's most closely watched currency corridors. Shifting now to the macro story that is setting the tone for every asset class on your screen this morning. The Federal Reserve's single most watched inflation gauge just landed, and the number is precise. Core PCE came in at 3.3% year-over-year for April, matching the Wall Street consensus exactly. Headline PCE printed at 3.8%, also right on the estimate. On the surface, an inline reading sounds benign, no panic, no euphoria. But in today's market context, where the S&P 500 is sitting at 7,524, and already down significantly. The implications beneath that consensus print are running deep and worth unpacking carefully. The Bureau of Economic Analysis confirmed this morning that core personal consumption expenditures inflation, the measure that strips out food and energy and sits at the center of every Federal Reserve policy deliberation, rose 3.3% year-over-year in April. Headline PCE, which includes those volatile components, came in at 3.8%. Both figures matched consensus estimates with no deviation whatsoever. That is a striking level of precision from forecasters, but the more critical data point is not the surprise factor. It is the absolute level itself. At 3.3% core, the Fed remains significantly above its 2% mandate, and the trajectory has been stubbornly flat for multiple consecutive months without meaningful downward progress. An inline print might feel like a neutral event, but in the current rate environment, it is anything but neutral, because consensus expectations had already been calibrated around a Fed that does not cut rates this cycle until inflation demonstrates a genuine, sustained downward trajectory. Core PCE at 3.3% with no downside surprise gives the Federal Reserve absolutely zero political or data-driven cover to pivot toward accommodation. Services inflation remains the structural engine keeping this number elevated, and wage growth feeding into shelter and services costs has not cooled sufficiently to break the stickiness. The Fed's higher-for-longer posture is not just preserved, it is reinforced by this April reading, and markets are repricing every duration-sensitive asset accordingly right now. The transmission mechanism from this print into specific tickers is direct and measurable. The 10-year Treasury yield is sitting at 4.53% this morning, up 123 basis points on the session, reflecting a market that sees no near-term rate relief. Long-term treasuries, the 20-year Treasury ETF, is under pressure in that environment as bond prices move inversely to yields. The Nasdaq 100 is the equity standout to the downside as long-duration growth stocks are most sensitive to elevated real rates. The Russell 2000 is down significantly. Small caps carry more floating-rate debt, making them acutely exposed to a sustained hold. The financial sector, by contrast, benefits directly as higher net interest margins widen when the 10-year holds at 4.53%. There are two technical levels that every macro trader is watching right now as a direct consequence of this PCE print. First, the 10-year Treasury yield at 4.53%. A sustained break above 4.60% would signal a full hawkish repricing of the rate curve, forcing another leg lower in both the Nasdaq 100 and long-term treasuries, and likely pushing the VIX, currently at 15.95 and up notably today, toward a breakout from its current range. Second, the S&P 500 at 7,524 is testing the 7,500 level as intraday support. A clean break below that round number on continued inflation concern would open a technically significant air pocket lower. Gold at 4,441.30 is also worth monitoring as the inflation hedge thesis. The question is whether investors rotate into it as a real asset store of value or sell it alongside risk assets. The bottom line on this April core PCE print is unambiguous. A 3.3% reading that lands exactly on consensus is not a green light for the Fed. It is a confirmation that the ceiling on rate cuts remains firmly in place. Elevated Treasury yields at 4.53% on the 10-year, the VIX at 15.95 repricing volatility premium higher, and growth stocks down significantly are all consistent expressions of a market digesting that reality in real time. Until core PCE shows a clear, consecutive month move toward lower levels, growth stocks, long-duration bonds, and rate-sensitive sectors face sustained headwinds. Those are the two stories that matter most this Friday morning. The full breakdown is on the screen. If this breakdown gave you an edge, hit subscribe and turn on the notification bell. We do this every single market morning, covering the stories and the specific levels that actually move your portfolio. The bell means you never miss an open.